Welcome everybody to the Dreams webinar, Opportunities in Distress, Investing in NPL Portfolios, Returns and Risk. And also welcome to our speakers today, which will be Antje Mertig, founder of Steinberg Management, José María Gil Robles, partner of DLA Piper Spain, Jan Döden, managing partner at Acida, and Alexandre Grelier, CEO of Dreams. My name is Jesper Radu, member of the board at PB3C, and I have the pleasure to be today's moderator. So thank you everybody for joining and welcome. So let's start with a quick check-in to the NPL markets in Europe. And Alex, maybe you can start by giving us a quick overview, as Dreams recently published a white paper on the NPL market in Europe based on the EBA numbers of the EBA this risk dashboard. So maybe you can go ahead and just describe what NPL market trends we can see across Europe.
Yeah, thank you, Jesper, very much for having us. Welcome everybody to this seminar on investing in NPL portfolios. I am very happy to be here, and indeed we did a research paper on the NPL market because what we saw as a virtual due diligence platform, we saw that we have increasingly more NPLs on our platform. So we were interested what that means for Europe, where we're active globally, or what does it especially mean for the countries like Spain, Germany, France, and others. So that was where the idea was born to do this panel here, and so I'm very happy that we have such a great panel together. To give you an overview, it's like a couple of years back, we had a pretty high quota in Europe with regards to NPLs. We were at roughly 7%, which then over the years has been decreasing due to strong regulations, because I think we're going to hear a lot about it. Which was then going down to now in 2024, roughly 1.932% on NPLs. So obviously, what is NPL? We have those which are which have a real estate underlying and other loans that we see. And so we have been focusing more on the NPLs with real estate underlying. What we figured out is that there is a slight shift. In former years, we have seen a pretty high amount of NPLs in Southern Europe. One could say that Southern Europe has done its homework, and we see a decrease in NPLs, while in Central Europe and Northern Europe, we see an increase. So if I look at countries like Germany or the Netherlands, we have a slight increase of NPLs. In Italy or Spain, or even in France, we see a decrease of NPLs. It's not huge; it's marginal, but you see a trend. And what we see definitely is that here in Central Europe, and especially in Germany, we in some asset classes we have a big increase of NPLs, which will be coming on the market. So this is for me now as a little teaser. And now back to you, Jesper.
Yes, thank you very much. So as Alexa said, in this webinar, we will also touch on certain markets. So I would invite you, Antje and Jan, to maybe dip into the German market, what you can see there regarding to distressed assets and NPLs with real estate underlying.
So at the moment, we see a lot of banks maybe sitting on non-performing loans. still struggling to get solutions implemented. With the beginning of the Ukraine war, there was a huge increase on building costs, interest rates raised as well. So a lot of developers are stuck in the situation or are still stuck in the situation. And we've seen several mandates or borrowers who are not able to complete their developments at all. So they haven't even started to build. However, they have to pay for interest and running costs for their projects, which in the end makes those overall investment costs no longer reasonable. And you won't find any buyer for such projects, even if they have been completed. And a lot of those cases are still in the bank books. We saw a lot of insolvencies of developing companies in Germany over the last years, not especially for office, but also for residential. However, the banks I think they start to consider the sale of loans to investors. We haven't seen a large wave yet. Compared to the last crisis, after the financial crisis, those portfolios might be substantially lower than compared 15 years ago. However, there is some movement in the market, and we also seen some smaller sales, maybe 10, 15 loans, 3-digit million amounts. However, there's not such a big movement in the market as I can see. And from asset classes, as I already said, it's a lot of residential developments are stuck. There is in Germany an overall lack of resi at the moment. So the government has the intention to support the building of 400,000 flats per year, and we are substantially behind this target. However, the question is who should build those apartments and flats. It's not really affordable at the moment. And the second issue I think we have with the office sector, where also only limited building activity can be seen, and also a lot of developers are stuck in this situation, and maybe they will end up either in insolvency or have to negotiate with their banks and funding partners haircuts to get things completed.
Jan, anything to add?
Oh, absolutely, but this doesn't mean that anything that Antje said was wrong. I fully support what she just said. Maybe going back to what Alexandre said, the entire white paper is based on statistics coming from the European Banking Authority, and that is where available statistics come from. I just believe that we have entered a new phase compared to the previous financial crisis, where in addition to banks, we have private credit funds, which have seen their rise in effectively since the last financial crisis, where banks learned and effectively dropped their LTVs from back then 90%, sometimes above 90%, to, I'd say, conservative 60 to 70% to be a lot more protected. Now, who filled the gap? That was private credit, either with whole loan funds, which would themselves cover the range of 0 to 80-85% LTV, or with mezzanine funds, who in some cases, certainly on project developments, would even fill the gap all the way up to 95% LTV. And those are figures that we don't see anywhere. It's what's called this gray financing market. And I think in the phase that we're looking at right now, that is super relevant. I was just looking at the Q2 numbers of EBA. I think if we take the absolute figure, we have 17.6 billion euros of NPLs in the corporate real estate space. I mean, just from my work alone, I could easily add another billion on top of that. And I certainly don't cover all of the gray financing market.
And I think what I'm trying to say is we're looking at statistics from the EBA and we see a problem getting bigger, but it is already much bigger than what the statistics show us, because many of the entities that have given debt or have lent cash on the basis of instruments similar to debt, they're not even covered by the EBA. So that's the piece where we know that there are NPLs, which are just not tracked by the EBA. And I think beyond that, we have lots of loans which currently can be serviced on when it comes to interest payments, amortization payments. But where my personal view is, it is highly doubtful that the asset values behind these loans will be sufficient to pay back the loan in full at maturity. And I think if you take a look closer into the numbers of different banks and you take a look at their financing activity, which hasn't really gone down in the last years. I mean, one would expect that with more difficulties and solvencies coming to the market, financing activity of the banks would be reduced. Yes, it has gone down. But if you take a look at what their actual financing activity is, depending on the bank you're looking at, 80% is just prolongations of existing financings, which kind of covers my point that we are in a market phase where real estate values, a sale of the underlying real estate wouldn't be sufficient to repay the outstanding loan amount. And the initial reaction is, well, let's just extend and hope it will get better in the future. The way I see it, I just think we'll never be able to get back to the times of 2022, not just in terms of interest rates, but if we're speaking of asset classes, I'm most concerned of, let's call it dated office assets, which currently still have cash flow to serve interest and principal, but where, as said, it is highly doubtful that a sale would be sufficient to repay the loan, let alone leave an equity piece for the current investor.
So it's some kind of a zombie loan where the loan is still serviced, but maybe looking at the stress in the future.
I fully agree. Zombie loan is an interesting way to call it, but in the end, it's clear. It's not really dead, but it's not really living either. So I think that's a very good description of these situations. I think the real question that comes up: what's going to happen in the future? Are real estate prices going to pick up again? I believe so, yes, but not by sufficient amounts to be able to repay the loans. So effectively what we're doing right now is we're dragging the problem out. And I would say that all of these loans currently being able to serve interest and amortization, which, I mean, let's think about it, are also very, very low interest rates because they were locked in the times where interest rates were still, below 2% when it came to real estate financing. So it's fairly easy to serve that interest. But again, looking forward, I don't really see the possibility of that being repaid. If I take a look at the market, I see a lot less opportunities than there should be. And my take on it is too many are still hoping that the tide will turn, and that a loan, which in my view is a clear NPL, is being kept performing artificially, as you called it, a zombie loan. And if I take a look at transactions that we've seen in the market, I summarize it and say you either need, from the sponsor, the bank, or the project, one of them needs to be abroad. In that case, something happens. If all three are German, speaking for the German market, it's like collusively, they all believe the best thing is not to do anything and just sit this out and see what next year or the year after brings.
Jose, just looking at the Southern European and Spanish market, as Alex said, we see in the EBA numbers, which only cover a part of the NPL market, of course, we see a shift where it seems that Southern Europe is farther down the timeline than Northern and Middle Europe in working out NPLs, getting them off the sheets in the banking sector. So what is the situation like in Southern Europe and Spain? And is it maybe a look into the future for the Northern and Middle European market?
Yeah, sometimes when I talk to my colleagues in the north of Europe, I feel like the ghost of the future of the Dickens novel, because they tell me, I mean, when they describe the market there, I feel like if I was in Spain in 2009, 2010, when all banks were playing the amend and extend game and not provisioning the loans enough as to allow for the sales of portfolios in not too painful terms. And now the market has, I mean, we have a much more mature market, and we are facing problems that you don't have. Even though Spain is still, for example, still has a fair amount of NPL loans. I mean, we have the second largest number of NPLs in Europe. I mean, and the situation is still much bigger. I mean, much worse than in Germany from that perspective. But it is true that since the start of the global financial crisis, I mean, banks have divested more than 260 billion euros of NPLs. So, I mean, they are now used to getting rid of the loans whenever they see fit, and they do that on a regular basis. They did not do it for a while. I mean, when interest rates started going up in 2022, I mean, the market was extremely quiet, but now it is back to normal now, and it is part of the toolkit now for the Spanish banks to get rid of these NPLs. That I think it is important to have in mind is that these NPLs do not stop being NPLs simply when they are traded to institutional investors. They are still the same miserable loans, but obviously that's no longer a concern for the for the banking authorities, because it is a problem now in the hands of someone that allegedly does not pose any systemic risk. But yeah, I mean, it's we are now having kind of a different problems and different like, I don't know, overcapacity in the serving industry, or banks getting rid of reperforming loans simply because they see that there's much money to be made there than with the traditional non-performing loans.
Antje and Jan, I know the both of you have a take on the overcapacity in the servicing industry, which I think in Northern and Middle Europe maybe poses another picture.
Yeah, I think we have the absolute opposite situation, certainly in Germany. I mean, we are coming from a super cycle of 10 years. Most banks, I mean, literally don't even or didn't have any workout departments in 2023, at least when it came to real estate loans, right? Corporates, you still have that situation, but real estate, it was like unheard of. You know, how can you default on a real estate loan in Germany? And so the professionalism from the banking side, due to missing workout experience, and certainly also from the, let's call it, private servicer side, is vastly reduced. I mean, it takes people like Antje and myself with, I mean, minimum 15 years experience in the industry to kind of still remember how do you work up these loans. how did that work? How is it even in such an NPL situation? And that I think is the biggest difference to Southern Europe. Indeed, Jose, you are the servicing companies in Spain are vast, same in Portugal. I'd say to a lesser extent in Italy, but the setup is much more professional. And where I disagree a bit, when you said the moment an NPL is transferred to an institutional investor, it's still the same loan. Yes, you are right. The loan didn't get any better, but what you did, you kind of cleaned the market, right? The bank wrote it off in their books after the sale. It's not part of the NPL quota of the bank anymore. They can, focus on new business again. And the losses have been seen in the market, right? You have a transactions also as orientation for other buyers. And the new institutional investors coming in, I mean, they're not coming in to make a loss on the NPL, right? They came in at a level hoping to make a profit. So also for them, it's about, moving ahead, creating transactions which create profit. And this is precisely what I'm missing in the German market when I look abroad. If I look abroad to the US, in my view, they're already past their real estate crisis that was induced in 22, 23 in the office sector. Have the assets disappeared? No, it's still the same shitty assets, right? But the sellers took the loss. They wrote it down. There's a new transaction price in the market. There's new investors which came in. And transactions, even though from a lower level, are happening again because everybody has an orientation point at where transactions are supposed to happen. Sellers and buyers actually agree on prices. If I take the parallel to the German market, what we have is, well, let's say buyers who want to buy at 80 and sellers who believe it's worth 100, mostly because they also have valuations that tell them it's worth 100. And the result is, well, nothing really. There's just no transaction. And I can't blame anybody, right? The buyer can't pay more just because the seller says I have a valuation which says it's worth more. Sellers, in some cases, let's take a look at the open-ended funds, aren't even allowed to sell below the valuations. So the situation just stays the same. Is that good? I don't believe so. In Germany, we're looking at 10-year low in transactions. And in other markets, as I said, they've been reignited at a different level, but the correct level, in my view.
I fully confirm this view. So we do have, I think, an issue with the valuations. I've saw a lot of loans where the lender said, okay, we have a 60% LTV. And after looking into this valuation into detail, it became obvious that maybe the LTV is 150 because all the assumptions made weren't realistic anymore. So, and then the lender ends up in this gap between having a valid valuation, telling them 60% value, and on the other hand, the market says it's 150, and then they are stuck between those values. I think this is one thing, and may I come back to the issue we had before with these zombie loans. We have a lot of stranded assets or assets becoming stranded in the future, which we find there aren't any investors or banks that are willing to fund this transformation. And even if you have an asset which would be worth refurbishing and investing in, it's very difficult to fund new projects at the moment. So on one hand, the banks are sitting on the NPL loans, and on the other hand, they are not willing to give new funding into the market to come out of the stuck situation. Maybe that's also an issue why this recovery or this cleaning of the market in Germany is not as fast as it is in the US or in other countries.
Alex, you had something to add.
I have a question, because from what I hear from our customers, especially here in Germany, is that they said already beginning 2025, they said, you will see there's now the big wave coming, because there is everything which needs to be refinanced from I don't know, like from the last 5 to 10 years, and which so now the new thing that I heard is it's going to happen in 2026, because now reality is really hitting the real estate sector, in terms of everybody now understood that valuation will never go back to where it was, and there is a lot of stranded assets out there. And so the question that I have and that I'm asking myself is like, how could it be possible that banks have prolongated, even though it was obviously that valuation is not there? And so because I see some of our customers who obviously are sitting on, or some of them are sitting on assets which are, let's say, in a friendly way, difficult, and they're still not like going aggressively into the market and say, okay, now we must take the hit, and the banks are sort of standing still. This is what I don't understand.
Well, I mean, where's the, I mean, what is, I mean, banks have no incentive whatsoever to acknowledge reality. I mean, it's I'm pretty sure that most of them know that the valuations they are dealing with are not particularly representative of the market, or are a bit optimistic, but they have no incentive for saying, okay, this is my valuation. It says that this asset is valued 100. Let's assume for provisioning purposes that it is just 80, and acknowledge a loss or a potential loss of 20. I mean, what's in the banks for doing that? Nothing. I mean, so you need to wait for a trigger, either that the money needs to be invested in the asset, or that external forces, force the banks to be a bit more realistic, as happened in Spain, Portugal, or Greece in 2011, 2012. That we were forced to acknowledge that that the banks were sitting on loans that were pretty much worthless. So.
Let's jump onto the opportunities, and maybe we can start with a quick look at the asset classes. Alex, maybe you could give us some insight retracted from the white paper, according to which asset classes are at risk of becoming NPLs and draw special attention. And maybe Antje, Jan, and Jose, you could add where and in which asset classes you see opportunities for investors, for turnaround investors, to maybe get a decent ROI.
Well, it's like from our report, and that's interesting because Antje already mentioned that living is like at risk. What we have seen is it's mostly office which is coming to risk, and this is due to the fact that there is, after COVID, this hybrid working, that office spaces, especially when they're not in prime locations, are pretty difficult to maintain attractive. A lot of investments need to be done, and so from our from our view and from what our report says, it is mainly office which will be coming into difficult times.
Look, I think, and that's the nice thing about these rounds when there are discussions on NPL and distress. Everybody has the same opinion. unless you have somebody from a bank or somebody from a valuation company. I fully agree with Alexandra. I think we've seen project developments as being the first element of distress for a very simple reason. There's no cash flow. So the moment nobody was ready to put in more money and no project developer, well, at the beginning they were ready to do it. At some point they either didn't have money any longer or just weren't prepared to throw more money at something where they knew they were out of the money. So project developments were the first ones to go into distress. And I absolutely believe that's also where the opportunities lie. Mainly because it's very, very difficult to, from the current situation, get it going again without changing the parties. The bank wants out because it's an NPL. They can't just really refinance, so it needs a new bank. The sponsor, as I said, potentially doesn't have any more money to put into it or to show a new equity piece, so it requires a new sponsor. And it actually requires a huge repricing because, as Antje said, interest rates have changed, building prices have gone up, exit prices have gone down. There's no way you can work off an old model. Now, what form of transactions do we see here? Sometimes it is called a loan sale, but that's more for, let's call it strategic reasons. I think project developments are so complex, you can't only take a look at the loan, you have to understand the entire project. And that's also why I believe we haven't really seen any loan portfolios on the market consisting of project developments, because you have this inherent complexity on each and every single project/loan, which makes it difficult to create a larger portfolio. And if we continue that, and that's why I'm so concerned about the office sector, just like Alexandra mentioned it, at some point you have a similar situation. So with office, let's take an easy example. You have a single tenant. So as long as the tenant is in there and he is paying rent, there's money to distribute. You can pay interest, you can pay a property manager, you can actually pay the energy companies, etc. So all is good, and the music stops playing, not necessarily when the loan matures, because we've seen then it just can't be extended. No, the music stops playing when the tenant moves out. And then you got the same situation like with project development. You have no cash coming in, and you actually have an asset in dire need of new cash having to come in. Now, everybody could say, well, yeah, maybe the tenant just stays forever. And this is where Alexandre was absolutely correct. In office, we've seen fundamental changes. So we've had COVID, hybrid working. We additionally now have an economic downturn in Germany, which certainly isn't making anything easier. But I think one of the major factors is actually ESG. So this might be less en vogue now that we have the Trump administration in place. But I still see tenants, investors, and even banks still setting a huge priority on, is this an, let's call it, ESG compliant asset? And no, let's face it, most office assets built before 2010, they're not ESG compliant. So if you have a tenant which effectively told his shareholders, his customers at some point that he wants to act climate friendly, he wants to be in ESG compliant offices, if nobody invests into the asset, he will move somewhere else at the first chance that he gets. And that's a real reason why everybody should be concerned. And in my view, banks should be weighing. Well, first of all, I don't think there are large hopes that the market is going to recover quickly and fast to levels that we've seen before. So that's not an option. So they are in between, okay, I can continue this game until the tenant moves out. Or potentially I try and sell the loan/asset now, or even force the sponsor to sell it now, as long as there is still a tenant in the asset. Because the moment the tenant moves out, that's where the real value destruction cures. I think office values have certainly gone down 25 to 30% from the peak. That's what we've already seen for an asset with a tenant. The moment the tenant moves out, I'd say it easily goes down 50 to 60% in value.
I think it's the ESG compliance is really a huge issue at the moment. So even if you are willing to refurbish the building and put it on top of the ESG levels, the question is it economically a useful investment? So for instance, we have in Frankfurt in the city some skyscrapers who are outdated. Actually, they are 25, 30 years old and would require a full refurbishment. And this investment is so huge that you won't be able to cover this with the rents you could achieve if a new tenant moves in. And this is not only an issue of the centralized office location. It's mostly an issue on the outskirts. So if you look at the offices which are not in the city, it's almost impossible to find a tenant who is able and willing to pay a rent which would help amortize the investment over the next years. So I see a lot of empty buildings and properties which may or very likely will remain empty, and you can't refurbish or convert offices, or not all offices, into resi buildings. So there are limitations. And at the moment, in addition with the economic downturn or recession we have in Germany, there is no demand. So I think a lot of those properties will end up nowhere and have no future. However, I see also initiatives in Germany that try to improve the ESG levels, and so there is some hope, but it's still a question who should pay for it, and I think that's the main question. Yeah.
Maybe just also the question: what would you advise in general? Buy a loan or buy the asset?
The asset.
I agree with Antje, but that's like asking, do you want to work 4 days a week or 5 days a week, right? That's everybody will say 4 days. So of course the asset transaction is always cleaner and easier, which is why in the loan transaction it normally comes, or let's not call it a loan transaction, let's call it a distressed transaction. Distressed transaction, meaning irrespective of what you're buying, it's not just the asset you have to deal with, but potentially the former owner, unpaid bills that you have no knowledge of. I mean, I see assets out there which haven't paid for energy bills in 6 months. No idea why they're still running, but I know it's the case. So all this complexity you need to price in, and pricing in that complexity means a lower price you'll pay. But I do agree with Antje. What we're currently seeing is the discount you're receiving for a distressed transaction in most cases isn't sufficient to cover the increased complexity that you have to deal with. And that's just, working on the asset. I think there's another element. The financing market is super difficult right now. If you want to do a new acquisition, you either have excellent relationships with your bank, potentially you just don't have a financing or very expensive financing. Now, if you move this forward and say, and this is for an asset deal, a clean asset deal, let's call it a non-distressed transaction. If you enter into a distressed transaction, chances that you find financing for it are very limited. I think in most cases, best chances, deal with a bank that's currently already financing the asset, because for them the situation might get better. But apart that, the way I see it, most distressed transactions are almost entirely all equity transactions until you can clean up the space and you can convince a bank to come in on the financing side.
Where would you, and maybe Jose, you can start on that, where would you see the key risks associated with NPL portfolios or distressed portfolios in the investment case?
I think the main risk is overpaying for the asset. I mean, it's if you do the valuation properly, if you value the asset properly, I mean, then you should be concerned about how the asset is managed after the acquisition. But my experience where investors get it wrong most of the times is with the valuation. With sometimes they overpay. They have pressure to put the money they get from the LPs to work, and that means that sometimes they feel they have to buy the asset at a price that is way too high. But in the past, there was a risk of not having management, capabilities to deal with the asset. But that is not a problem any longer in Spain, except for certain assets. I mean, for re-performing loans, there is not enough servicing capability because it's been built around residential assets and unsecured loans, but not for re-performing loans. But I think to me these are the two big risks: overpaying and not having the right asset manager.
Antje, what would you be your advice for maximizing the return on investment besides, of course, paying a price which is attractive for you on the buyer side?
I think it's the most important part is the due diligence part. So you need to understand what you're buying. So it's at least you buy an asset which requires either redevelopment or restructuring or whatsoever. So you need to understand what the future of this asset is. As Jan said, maybe today you have a tenant and you get some rent, but if you not invest and if you have no idea of what to do with the asset, you can't estimate the value. And the values we receive from the valuers are usually very static. So you need to have a dynamic calculation of the asset and the cash flows for the future. I think this is one point. And the second point is you need to understand how you can get hold of the asset. So if you're interested in develop the asset, you need a strategy how to do the workout. And so is it via a insolvency proceedings or forced auction, or can you find a solution with the borrower? You need to understand this before, because this has an impact on timing and also on cost. And what we experience at the moment is that the courts are very busy, so it takes quite long to come to an auction. So sometimes 18, 24 months. In best case, it takes 9 to 12. However, still you have to fund this timing somehow. So if you bought the asset or the loan, your interest is running, cost is running. So I think understanding the timing, the exit strategy, and also the asset are important before you buy. And then ideally put some buffer on it, and this helps you to understand the right pricing or come to the right pricing.
Maybe before we jump to the short take on the legal and regulatory issues, just the question in the round: under which circumstances is an investment in distressed assets or NPLs a case for a mainstream investor?
I think Jan can answer that question. I don't believe it is an opportunity for a mainstream investor, because what we heard from Antje, it is extremely complex. A lot of regulations need to be understood. The due diligence need to be done in a broad way, and especially from what I see is that documentation today is still not great, which is surprising. But I don't know if you guys see that the same. But whenever we get a distressed portfolio, usually the documentation around the asset itself, around all regulatory topics like ESG and others, are not great. And again, it's we see it maybe on my gray hair. It's not. I'm since quite a while in the market, and I've been around when Lehman broke down, and I've seen all these kind of things. And in 2003, when the dot-com bubble bursted, same thing. It's always the same question. Why is the underlying documentation, which enables people to do a correct due diligence, why is that such a mess, to be very honest? Yeah, it's like, and that's a question I cannot answer here, but I can only advise on really being careful with the documentation, because it has more value than one thing.
Yeah, I was just going to support what all the other speakers just said. Distressed transactions are complex. It's absolutely nothing for the mainstream investor. Every investor that wants to deal with it needs to understand what is his path to getting to the actual asset. I think that's the important piece. Because right now, and I think there's also two types of distressed investors. When I used to work for Lone Star, it was a kind of wholesale to retail, but we didn't do that much on the asset. So we would buy a portfolio of loans, and then we would sell assets, but not much happened with the asset in between. I think if it's about opportunities right now, who are the right buyers and who can probably make the most money, it's those who buy the loan but actually want to own the asset because they already have a plan for the asset. It's not about buying a loan, then selling the asset as quickly as possible, but it's, buying the loan, owning the asset, investing into the asset, finishing the project development, investing into the office building. That's where you can achieve most. But all of that needs to be understood. And as I pointed out in the beginning, certainly in Germany, we are lacking the experience in the last years. And that's not just people who have the experience in working out loans, but as Antje said, I mean, even the courts are kind of surprised at where all these foreclosures coming from. This is like something new. We don't know how to deal with it. I mean, think about the insolvency quota in Germany in the years 2018 until 2022, with the added effect of COVID, which everybody would have thought, okay, that's going to create lots of insolvencies. What it did was create zero insolvencies for the moratorium period of about 24 months. So even on the insolvency administrator side, you don't really have a capacity that you need to deal with it. And everybody's been, overrun with the events of 2023 and 2024. And I like what you said, Alexandre, with everybody in early 25 saying, okay, this is the year where we're going to clean up. And then they get to the point in, oh yeah, but this could have these consequences. Maybe let's clean up in 26. So hopefully it's going to be 2026, because I really would like to see a functioning market again.
So just to wrap that part up, mainstream investors, well, if they want to go into NPLs and distressed, probably need a good advisory support, where we have some good advisors here on our panel, or maybe look for a fund solution to not invest directly into NPLs or distressed assets, but via a fund manager or some investment vehicle. Just before we wrap things up, Jose, maybe you could give us some insight into the development on the regulatory and legal side, especially as EU in 2021 allegedly lowered the regulatory barriers for non-banks to acquire NPLs, which turned out in some member states, as Germany, to make things even more complex for private investors. But let's hear about that.
Yeah, I think that the issue with regulation is that, I mean, each country has its own regulations. I mean, in Spain, for years, it's been possible to buy loans without being a licensed entity, but that was not the case, for example, in Italy. So I think the market adjusted to that, and in Italy, you were not going to be buying directly loans, but through securitization structures. Whilst in Spain, we were using still direct sales, but we don't use them, for example, for reperforming loans. I mean, we still do, but we predominantly use securitization structures. So the theory, I mean, the European authorities are very concerned and have been very concerned for several years now on I mean, easing the restrictions that some countries have to allow investors to buy these non-performing assets from the banks, so that the banks can start doing some cleansing. But I mean, no matter how aggressive you are with the changes, I mean, the only changes that I've seen that work are those forcing banks to acknowledge reality. If they don't do that, I mean, it doesn't matter if you no longer require a license to buy an asset, because you are not going to. I mean, there is not going to be enough. If there is not enough offer, I mean, the demand will not be met. So I think the only way that the authorities can force the banks to do real cleansing is to force them to realize or to assume that the valuations they are using are not the right ones. I mean, that they are overly optimistic. Until that happens, I mean, they'll keep trying. They'll keep lowering the barriers to entry. They keep limiting the requirements that investors need to meet to purchase non-performing assets. But I'm not very confident that it will work.
Right. Thank you, Jose. Anything to add, Antje, Alex, and Jan, on that complex?
So maybe it's also important that not everybody can buy a loan in Germany. So we have the Secondary Credit Market Act in place since last year, and that requires banks to notify BaFin if they sell, and also you can also service those loans if you have a licensed credit servicer. So it's back in the times of Loan Star and Co. It was possible for almost every company to buy loans from banks. However, this has been restricted. And the idea was to enhance sales and make it easier. But what I experience is that it added more complexity at the end. Nevertheless, this only applies to bank loans, not to those loans given by funds or mezzanine lenders.
Which, as Jan stated, make up a lot of or a great portion of the grey market, which is not tracked by EBA or other official numbers. Right. Thank you very much. Just looking at the time, we're heading towards the end of our webinar. If our spectators have any questions left, please don't hesitate to contact me or one of our panelists and speakers, and we will try to answer them as good as we can. if you're interested in the white paper on NPLs by Dreams, just you can look it up on the website, or you just ping us on some platform as LinkedIn or else, and we will get back to you with that. Otherwise, I only have to say thank you for joining in, and thank you, Antje, thank you, Jose, thank you, Jan, and thank you, Alex, for joining us for our discussion today. And have a nice day. Goodbye.